The Fed's cutting interest rates next month, and that'll impact everything from your credit cards, savings accounts, investments, your mortgage if you have one, car loans, even your job. And most people won't notice until it's too late. But you're not going to be most people, because I'm going to break down exactly what to do, what to expect, what rate cuts mean in the first place, how it'll impact you, and how to position yourself to capitalize and take advantage from it. Quick disclaimer, I'm not a licensed financial, tax, or legal professional. Nothing in this video is advice. Always consult with a qualified licensed expert before making any financial decisions. So, according to the CME Group's Fed Watch tool, there's about a 90% chance that the Fed is going to cut interest rates next month. And the White House has been pressuring the Fed to cut rates. Trump's been super vocal about it. Trump's called the Fed chair Powell too late Powell, a stubborn moron, a fool. He told the Fed's board to assume control from Powell if he won't cut, and even floated the idea of firing him, even though the Fed chair can't be removed without cause. And he's appointed advocates for aggressive rate cuts to the Fed's board and floated potential replacements who share the same stance. And the pressure is political, but the impacts will hit you no matter right or left, Republican, Democrat, conservative, liberal, it doesn't matter. On a basic level, the Federal Reserve controls interest rates. Lower interest rates means it's easier for you to borrow money. More people can afford the monthly payment with a lower interest rate. More people will be approved for loans. It impacts credit cards, auto loans, mortgages, and even the businesses themselves. And the reality is, right now, the economy's slowing. People are holding on to their money and businesses are pulling in less. Another thing is the federal deficit is climbing, which means the gap between what the government spends and what it brings in is getting bigger. So rate cuts mean easier access to money, but easier access to money means more spending. More spending means more demand. More demand means higher prices. And unfortunately, inflation squeezes profits. So companies have to cut payroll to protect the bottom line. That's high inflation and high unemployment at the same time, which is the definition of stagflation. And whether intentional or not, inflation reduces the real value of debt. What's owed is repaid with dollars that buy less than it did before, which also reduces the burden of the deficit over time. Think about it. If I lent you $100 10 years ago, you could buy 100 items from Taco Bell or the dollar store. If you paid me back today, that same $100 wouldn't buy the same that it did 10 years ago. So how can you take advantage of this and capitalize on the upcoming rate cuts? Well, if you have a retirement account like a 401k, it's time to check where that money is invested. Where is it sitting? You might want to consider reallocating a portion of your investment into stable value funds. These are things like treasury bonds and corporate bonds, things that pay fixed interest. And you can also lock in high rates now with CDs, certificates of deposits. So if you've got some cash that you won't need till a certain date, a CD might be an appropriate option. So again, cheaper credit fuels spending. Demand outpaces supply and prices rise. So the Fed's caught in a trap, right? If they cut more, they risk runaway inflation. If they hike or keep rates high for too long, they risk a recession. Businesses facing higher costs start cutting jobs. That's how we get stagflation. And it's a risk when rate cuts happen in a high cost environment. Markets might rally at first, but if company earnings start to slide because of layoffs, those gains can often fade. If you have debt, wait on refinancing, right? So I think one of the most important things is your career, right? Take care of your job. If your industry is vulnerable, get ready. Build your cash cushion, side income, have a backup plan, right? Because we don't win by reacting to the headlines. We win by already being in position when they break. The rate cut next month is a warning shot, right? It won't trickle down to us immediately. It'll be slow, but it's coming, and we need to be prepared. So as always, you can't seek answers to questions you've never conceived. So subscribe, come along the journey, and we'll see you there. Also check out the links in the description below for some cool apparel and my recommended read.